In today's volatile financial landscape, a significant shift in investment strategies may be necessary for future success. While we can't predict the future with certainty, understanding the current state of the markets is crucial. The Federal Reserve's policies have historically played a pivotal role in shaping financial conditions. For instance, in 1980, the federal funds rate soared to 20%, with loan rates reaching as high as 22%. Fast forward to today, and we find ourselves in an environment where the rates dropped to nearly zero, drastically altering the financial landscape. This unprecedented decline in interest rates, over 20 percentage points, has fundamentally transformed borrowing and investing dynamics, resulting in the longest bull market in history from 2009 to 2021. Businesses thrived in this low-rate environment, leading to minimal defaults and bankruptcies. However, the narrative is changing. The era of easy money appears to be coming to an end, and it raises concerns for investors navigating this new landscape. The US dollar has long held its status as the world's reserve currency, allowing the US to operate with a level of financial flexibility that few other nations possess. In the short term, this gives the government the ability to manage its obligations without immediate risk of default. However, this status is not guaranteed indefinitely, and leveraging it for negotiations can be perilous. As we transition away from a prolonged period of low interest rates, the implications for investment portfolios are profound. Moving forward, what you include in your portfolio may differ significantly from what was previously effective. Many investors, having experienced only declining or ultra-low rates for the past 4 decades, may wrongly assume that such conditions are the norm. However, a fundamental shift, referred to as a sea change, is underway, and it demands a reevaluation of investment strategies. Current trends suggest that we may see interest rates stabilizing between 2% and 4%, a departure from the emergency measures of the past 13 years. With inflation remaining a persistent concern, it's vital to understand that the environment is shifting, and so must our investment approaches. As borrowing becomes more costly, businesses that previously thrived may find themselves struggling to refinance debt, leading to higher default rates. Historically, high-yield bonds have averaged a default rate of around 4%, a figure we haven't approached in recent years due to the favorable conditions. However, the upcoming years may challenge this norm. Investors must recognize that credit instruments, such as corporate loans and high-yield bonds, now present an opportunity to achieve returns comparable to equities, often with less risk. In a tightening credit environment, the ability to assess value becomes paramount. Bottom-up analysis, which focuses on identifying undervalued opportunities, may prove more advantageous than top-down strategies that attempt to predict economic trends. As the markets become less accommodating, companies that face difficulties will struggle to secure financing. The ease with which funds were raised in the past will likely diminish, resulting in a more cautious investment landscape. While we're not anticipating a financial crisis, a return to a more normalized state of affairs will require investors to adapt their strategies. Investing is inherently complex and fraught with uncertainty. The key to success lies not only in identifying attractive opportunities but also in understanding the psychological aspects of market behavior. Investors often make mistakes by assuming a direct correlation between a company's performance and its stock price, neglecting the human element that drives market reactions. When seeking investment advice, it's essential to consider individual circumstances. Investment decisions should align with one's financial situation, risk tolerance, and long-term goals. The best approach is to focus on investments that match your needs, allowing you to navigate the inevitable market fluctuations without undue stress. In summary, the investment landscape is evolving, and recognizing this shift is crucial for future success. By adjusting portfolios to reflect these changes, investors can position themselves for success in an environment that may no longer favor easy money. Embracing a more analytical approach will help navigate the complexities of the market, allowing for informed and strategic decision-making as we move